Thank you, and good morning, everyone. Warm congratulations to the organizers on another world-class HBS Africa Summit. During my time at the World Economic Forum, I had the great pleasure of working closely with our keynote speaker for this morning, Africa's own Iron Lady, Ms. Nyembezi-Heita. Forbes magazine recently named her among the 10 most powerful black women in the world in the company of Michelle Obama, Oprah Winfrey, and Ellen Johnson Sirleaf. Ms. Nyembezi-Heita is currently the Chief Executive Officer of Arcelor Mittal, South Africa, the largest steel producer on the African continent, and subsidiary of Arcelor Mittal Group, the largest steel producer in the world. She was appointed to this position in March 2008, and since then has led the company with a steady hand, despite facing a number of high-profile boardroom battles and the challenges of the recent economic crisis. Prior to ArcelorMittal, Ms. Nyembezi-Heita served as head of mergers and acquisitions for Vodacom Group, and prior to that was CEO of Alliance Capital. She currently serves as non-executive director on the boards of Old Mutual and the Johannesburg Stock Exchange. With a professed love for science and math, she holds a Bachelor of Science and a master's degree in engineering, as well as an MBA from the Open University UK. In addition to her impressive credentials, she's a wonderful wife and mother of 2, and apparently this woman of steel gets her inspiration from Bikram yoga and going to the ballet. With no further ado, please welcome Ms. Nyembezi-Heita.
Thank you very much, Catherine. When you do the first slot, particularly from my kind of vantage point, you actually think of doing 2 sets of speeches. The first one is if the room actually has anybody in it, and another one in case you have to speak to empty chairs. And just before you all walked in this morning, we were sitting at the front here, and I was thinking, yeah, maybe I should have brought the speech with the empty chairs. So I'm very relieved to see you all. And I suppose the organizers also do the same with the speakers, and they sit there wondering if the people will actually turn up. So today we have a wonderful combination of the speaker being actually in the room, sans her luggage, which got lost en route from Johannesburg. But at least we can get together, and maybe I can share with you what the people not in this room, Catherine, think about Africa and where we are today, and particularly from the point of view of an operator. Now, a few years ago, maybe I'm going back 3-4 years, The Economist magazine ran a cover story, and this cover was Africa, the Lost Continent. In my mind, this stands out. I've never actually forgotten that particular episode, and I did keep it because it seemed that things started to change at a much greater pace almost from that moment onwards. It was almost like the peak of the Afro-pessimism that we'd been fighting for decades and decades, for those of us who've been excited about the prospects for Africa for a long time. So imagine the excitement a few years later, on December 3rd last year to be precise, when that self-same magazine ran yet another story, and this time the caption was, Africa Rising, the hopeful continent. So there has been a major shift, and although the reasons for that particular shift are very interesting and talk to some of the things that Catherine spoke about just a little bit earlier, it's not actually the topic that I want to speak to or been asked to speak to you about this morning. What I'm here to talk about are the challenges of doing business in South Africa and Africa as a whole, in terms of the continental challenges that everybody knows about, but do that at a more granular level. Is it actually really, really possible for a private company operating in the African continent today to be globally competitive? And what are some of the hurdles that we have to overcome on our way to being to competing with others on par, and how do we set about doing that? So that's basically what I'm going to try and do, and just segue all over the continent to try and illustrate the points. Someone once said the principal difference between a senior executive in a developed market versus a developing one is the fact that in the former case, About 80% of your day is fairly routine, fairly predictable. You know what you're going to do when you walk into the office. And 20% may present you with things that are new, different, that need a little bit of imagination to solve. In an emerging economy, on the other hand, 20% of your day tops is routine. The other 80% presents you with things that you simply never imagined you'd have to deal with ever in your life. So fundamentally, the first thing that you have to develop and be certain that you've got a grasp on is an adaptive capability. Without that, actually, I don't think that you should even be putting yourself out there in terms of working in the private sector in our kind of environment. Now, I don't have to tell the audience sitting here, particularly the people of the business school, that fundamentally there are building blocks to competition that are the same, whether you are in the steel industry, in the mining industry, whether you are in Boston or in Johannesburg. And the very first one is clarity about what it is that constitutes competitive advantage for you as a firm. So in the case of Mittal South Africa, for example, we have always staked our competitiveness on cheap raw materials. We've got plenty of those in South Africa. Cheap labor and cheap energy. South Africa has had the lowest tariffs of electricity of any country on earth for many, many years, up until about 4 or 5 years ago. Furthermore, we would go a step further and took the view that because of where we are, we don't have access to the level of advanced skills that you may find, for example, in the Northern Hemisphere. So we would compete at the commodity end of steel industry, and therefore it becomes very important to guard that low-cost position very jealously, because it's the only way that you're ever going to make headway. So you need to keep that at the back of your mind as I go through some of the hurdles that we overcome in trying to achieve just that. So starting off with trade. Trade in the African continent is a bit of a strange thing, because although it's always been a big part of how Africans trade, it's always been between Africa and another, and the other being outside of the African continent. In 2010, for example, in total, African trade constituted $300 billion, which is not a small number, of which South Africa constituted 60%. Angola came in at a distant second, accounting for 16%, and Botswana was a third at 4% of total trade. However, when you start looking at how much of this flows between one African country and another, the picture is very, very different. It's a minuscule part of that number. Now, because we thought Africa was a growing market, we would stop exporting our steel anywhere else and focus on the African continent. We took this decision having already built a fairly thriving business with East African steelmakers, where we produced steel and we shipped it up to Kenya through the port of Mombasa. So we took this bold step that would now start servicing the markets that are closest to South Africa, which could all be reached by road. And this is where the fun really began. The very first thing is, when you trade with people, it becomes kind of important that you get your product to them. Now, if you're sitting in Boston and you wanted to, say, export stuff to Brazil, you'll probably call a few transport companies, get quotations, select the best one, and hey, presto, off you go. Well, in our case, it didn't work out quite that way. Firstly, we couldn't find transport companies based in South Africa that services cross-border trade. Firstly, that was just the first thing. So what do you do then? What we did was get on a plane, travel to Zambia, travel to Harare, travel to wherever else we need to go to, and actually source transport companies from those markets. So if you can well imagine you want to ship something from here, but you have to go to there first to go and get somebody to come back here in order to move the goods for you. And essentially, that's basically how we've had to contend with that particular one. That was reasonably successful. The second part of it was now to deal with the issue of customs. Catherine spoke a little bit about integration. Now, SADC is a trading bloc, and from the face of it, it may seem that there is some integration that goes on within the region. You've got the same at COMESA, ECOWAS, and so forth. But when we started moving goods across the border, we would find that the 750-mile journey from Johannesburg, say, to the Zambian capital in Lusaka, which could take you, a day and a half, maybe if you were driving, could take a truck 2 weeks. The 2 weeks really was about border clearance delays, which even today we actually haven't found a solution for. One of the largest retailers, food retailers in South Africa that trades in SADC, trades through 13 countries in the SADC region, recently reported that any one of their trucks that goes out has 1,600 pieces of documentation in it in order to clear the export taxes, import licenses, VAT waivers, whatever it is that is required as you go from one country to the other. So the issue of regional integration is not some nice to have because it seems to make sense, because it's great to expand markets. It is actually the one way that becomes an enabler to trade, without which it's very difficult to see how Africa can actually realize its full potential. We actually found our customers further north very flexible. And this is the one thing about Africans that you find just about anywhere you go is levels of flexibility and resourcefulness to get around these kinds of problems. So, for example, our Mozambican customers, we take a truck, we put it at the border, they come out, they clear the truck, the goods still on the truck in order for them to go into the country, something that would not normally happen. You would not expect customers to actually go to that. So without this level of flexibility and collaboration between the one party and the other, it simply would be impossible to do any kind of business. The one thing that is very well understood is that in order to do anything more than we're doing on the African continent, we need to address the issue of logistics, not only from a cost perspective, but also the infrastructural perspective. And I will talk a lot about infrastructure today because in my mind, it almost is the one block that keeps companies like ours from really, really competing on a global scale. Logistics costs have been recognized as a major impediment in the effort to stimulate intra-African trade, given that the big focus always was to go from a particular mine to the port. Current studies indicate that regional trade, such as bilateral agreements, of which we do quite a lot of one-to-one, country-to-country type of trade, they've been very instrumental in promoting trade and directing foreign investment from one African country into another. But much, much more needs to be done to promote infrastructure development in Africa, including strengthening cross-border programs, as I've just spoken about, but in particular, in my mind, at this point, the African countries need to think about joint infrastructure developments. Now, if you think about Mozambique, Mozambique today is like the second scramble for Africa. They have discovered vast coking coal reserves, and everybody and their uncle is in there trying to get their piece of it. But where the country has been very fortunate is to attract global miners of the like of Rio Tinto and Vale. And what this has done is, over and above the money that is going into the coal mining, Vale announced a $4 billion infrastructure development program whereby they're going to build ports, they're going to build coal terminals, but in particular they're going to refurbish and build on railway lines in order to get their goods across Malawi onto the port. This is now one of those really big ticket programs that involve two countries, Malawi and Mozambique, primarily in Mozambique, that we need to see much, much more of. But African companies such as ourselves don't really have the capacity to do this on our own. We do need to get some of the global companies coming into the continent and partnering with local firms in order to do this. What is also true is that African governments have recognized this, and today, whenever a country has a concession or a licensing that it does with a foreign investor, typically, this is a very big part of it, the concession would involve, in some kind or another, a big infrastructure investment part of it. Now, from a South African perspective, there is enough finance that is slashing through the country. Our transport utility has announced a $35 billion investment over 5 years to refurbish our railway lines as well as our port networks in order to furnish the infrastructure to power economic activity. The next challenge in cross-border trade is credit risk. There are not many credit insurance companies, as you can well imagine, that deal with the countries that we wish to do business with. And the typical company that we would deal with that has a head office in France and maybe in Johannesburg tend not to want to get involved in little countries that they actually have not very much background on. So from a company perspective, what we do is we put people again in a truck, in a plane, to go and begin to study those markets in far more detail, so we gain a more nuanced understanding of the risks that present in those markets. And very often, actually, they're not that large. Sometimes what happens is we get overcome because systems of accounting are not the same. We can't open an account if people don't have audited financials, but very many countries we deal with, that is not a requirement. A company may be absolutely solid, but doesn't have audited financials, and therefore we can't deal with them. So that becomes a very critical piece of the puzzle as well to solve in doing any kind of cross-border trade. And essentially, we've been able to get around, not really solve, but get around that problem, again, by relying on customers and the flexibility that they demonstrate in doing this trade with us. So, for example, a lot of companies will give us bank guarantees. Now, you could say that's not a really big solution, but the next best alternative is an import of the same product, which means that they would have, again, to find financing behind that in letters of credit and the like. We do open cash accounts to take a big risk with our customers, but what tends to happen is because we do produce commodity products, we can take cash just as we start to dispatch a product rather than at the beginning of the product. In that way, it becomes a 50-50 between the supplier and the customer. We also use extensively letters of credit and standby letters of credit, which typically become a requirement when there are very large volume orders that need to be produced and shipped to customers. Very often, the kind of problems that we have to face are things like there is just no foreign exchange in the country in which you're wanting to do the business. Typically, in that part of the world, all the business is done in US dollars, and a country may just not have enough of that. Something as simple as that becomes the blockages in doing business on the continent. If I go back to the issue again of infrastructure, logistics is one, but solving the power problem is another very big one to tackle. It's a critical piece, and actually none of the kind of beneficiation plans or the industrialization plans that African countries are putting on the table are ever going to happen without the continent solving this particular problem. What is so strange is that as a continent, we are blessed with abundant energy resources, but they are underexploited, and there is insufficient funding, insufficient technology to open up all of these particular sources. The one that has captured everybody's imagination, either positively or negatively, depending on your outlook, is the so-called Grand Inga project. This is a joint infrastructure development that was announced by South Africa jointly with the Democratic Republic of Congo in November last year. But actually, this project has been going on literally for decades, and the idea behind it is to build a major hydroelectric power project to bring electricity to almost half of the continent's 900 million people. This will be built 225 kilometers southwest of the DRC, built on where the Congo River drops into the so-called Inga Falls, and this will be bigger actually than the Chinese Three Gorges Dam, and which had been the biggest one up till then, generating in excess of 40,000 megawatts at a cost of $80 billion. So now South Africa and the DRC want to champion this, but clearly there is insufficient bank-rolling capability between those two countries to do this, and have to get all sorts of development finance institutions getting involved, which is where the blocker really is. Political risk comes to the fore. People would have preferred the Congo River not to have been in the DRC, apparently. And of course, the gigantic price tag means that this is going to be a long way to come. It's going to be a long way coming. And we've been told that this is a dream, a big dream, it will never happen. But essentially, if Africans don't start dreaming big dreams and working really tirelessly to bring them to fruition, we just never will break through. We do need these kinds of large breakthrough projects where you dare to dream perhaps the unimaginable. The last infrastructural barrier I want to talk about is ICT. No business can hope to compete effectively in today's world without a modicum of information technology platform. In fact, people of my age, we don't understand half of it. There were things on that board that I didn't really understand. But this, at a very basic level, remains a challenge on the African continent. Now, it is true that just recently we've enjoyed something of a resuscitation because our telecoms has taken off. If I just give you the numbers, in 2000 we had 11 million mobile phone users on the continent-wide. This figure had risen dramatically to 400 million by 2011. And essentially what happened here is that market liberalization was permitted, and it's the one big sector where this was attempted by all the governments of Africa. Up until then, we had predominantly fixed line operators operated by government-owned institutions, which just simply failed to meet consumer demand. This was a very big example of perhaps where we've gone wrong, in the sense that we haven't tapped into the power of the private sector and their hunger for profit in order to drive economic growth. So now Africa has moved quite a lot faster in this area, and very recently made an even bigger stride in an undersea cable that was landed by a company, another private company, Seacom, which is a 17,000-kilometer undersea cable along the eastern and southern coast, and I'm sure a lot of people sitting in this room have got a real sense of what this can deliver, for example, in a place like Kenya, where up until that point, all of the broadband that they had was delivered through satellite, and suddenly you had this bulk bandwidth coming in this undersea cable. Again, this was done by the private sector. So the whole idea that we will have government coming in to deliver big projects in order to fuel growth and boost economic development in Africa, in my mind, is an anomaly. It will take the power of individuals and companies working in very many different areas to begin to light many fires, and eventually they all join up to become a very big fire in the future. The uptake of broadband along that coast has actually been remarkable. In a very short space of time, it's grown almost 10 times. So there's quite a lot that we're still looking forward to in the future in that area. But now, it is true that infrastructure and deficiencies in infrastructure can be a very big block in companies conducting business with each other, trading profitably, and keeping their costs low. But remember that the infrastructure itself is just the ticket to the game. It's not the game itself. The game itself is growth. It's economic growth, and it's the wherewithal that will lift all of these millions of people out of poverty in a continent that badly needs it today. Over the past few decades, African countries, in their various small, fragmented way, have really made big attempts to industrialize their economies. These efforts have failed in the past due really largely to the fact that the markets are too small to support the kind of level of industrialization that you really require in order to be globally competitive. In 2010, industrial growth in Africa increased at an average rate of 7.8%, with manufacturing dominating, coming in at 8.9%, followed by the mining sector. Eastern and Southern Africa grew the highest, with South Africa, of course, being a very big part of that. But we see in West and Central Africa, for example, that the growth rate of the manufacturing sector has actually diminished, has actually declined compared to the decade before. So those are all the worrying signals that the continent is not growing at a uniform pace. There are areas that are growing much quicker than others. African countries continue to export raw materials to other regions globally with little or no local beneficiation. For Africa to be on par with the rest of the advanced economies in pursuit of industrial development, there is a need for regional groupings to develop common industrial policies geared towards significantly increasing productivity and competitiveness, at the same time helping to create jobs. It's also imperative that we begin to focus on more value-added manufacturing and mineral beneficiation, and that these are promoted through appropriate development financial schemes. This is not to suggest that this is a particularly easy thing to do. It is easy to say, and we all say it all of the time, but the fact of the matter is that this is a hellishly difficult thing to achieve. And you need look no further than the recent Nigerian oil sector development to see just how difficult it is to do this. Now, Nigeria has been faced with this contradiction where Because of the rising price of oil, they've been able to get much more in terms of earnings externally for the oil that they sell, but they have to have the additional expense burden of getting the oil in refined form, which clearly the Nigerian authorities must desperately want to rectify. But as we saw, the social costs of doing so is really, really daunting. But clearly, without adequate energy supply, we're going to go nowhere. It's going to be impossible to industrialize our economies, let alone compete on par with our global peers. And this applies particularly to electricity, which has failed quite a number of companies in the metals processing sector in South Africa because of the recent rise in the electricity prices. There is no question, though, that it can be done. If you look at the industry in which I am a part, the iron and steel industry in South Africa, we have mines from which we buy iron ore and most of the coal that we need. We have a thriving steel industry that converts that into primary steel. We have downstream manufacturing that takes that primary steel, converts it into end products, finished products, spades, wheelbarrows, you name it. And if you were to walk into a hardware store, you're most likely going to buy nuts and bolts that we produced in South Africa at a competitive price, or at least it was that way until the advent of China, which I'll speak about in a minute. Another barrier is lack of skills. I don't think that any address like this would be complete without touching on that subject, even if I don't touch on it in any great massive detail. It's very well understood. And so the question that you have to ask yourself is, if you are trying to employ artisans and engineers in a country like South Africa with such a limited pool, how do companies actually go about solving that particular problem? The first one is that corporates in South Africa are very, very involved in funding education in one form or another, whether it's funding schools themselves or funding bursary students, and we do a huge amount of that. We also do a fair bit of our own skills development, whether for our own use or for the country as a whole. So, for example, at Arcelor Mittal South Africa today, we have upwards of 3,000 people at some level or another of either university training or skills development program, which is quite significant when you compare it with the 11,000 people that we employ on a full-time basis. And this is not just an Arcelor Mittal issue, it's for all large corporates in South Africa. We all do this because it is a very big part of what we can do to support economic growth in South Africa and support government efforts in the education space. But there's no question that this is a long-term or medium to long-term effort. It's not going to give us results tomorrow. A key short-term one is to open the country to immigration. And this has been a bugbear in all African countries that I have ever gone to. It is very, very difficult to get movement of people, particularly with advanced skills, coming into the country. Eventually, what we have done at company level is to talk to government about the need to bring in advanced skills in order to power economic growth, which we've had some success in doing, and up until this point have been allowed to bring in 1,000 people with advanced skills to come in on a special dispensation for a period of time, provided that there's a skills transfer that happens with that. So the message is South Africa is open for business, so people who want to come to South Africa, talk to me afterwards. Over and above competitiveness at individual company level, it is vital that African countries also seek to be competitive at country level. According to the latest World Economic Forum Global Competitiveness Report, we had 7 African countries that placed in the top 100, with South Africa coming in 50th in that listing. Now, it was quite interesting to read where South Africa scored the highest. It scored highly on the quality of institutions and factor allocation, such as intellectual property protection, property rights, accountability of private institutions and its goods, market efficiency, as well as business sophistication and innovation. The weaknesses, the panel pointed out, were tackling, of course, labor market efficiency, university enrollments, infrastructure, security, and health of the workforce. Now, it may be quite surprising to hear that there is a company or there's a country in Africa that today will be scoring high for innovation. But if you have listened quite carefully to the remarks I've made up till now, it almost is the only way that you can remain relevant as a company is to try and find small incremental innovations to tackle the unique problems that you encounter on a daily basis. As I said before, from an Mittal perspective, what has hurt us the most is loss of competitiveness insofar as energy costs are involved, but there's also labor costs which have been rising just at the time that Chinese competition was at its most severe. So if I now turn to Chinese competition and how that has affected the domestic market, I don't think there's a company in the steel industry today that at some point or another does not confront the issue of China. China has been an astonishing story insofar as how it's grown over a short period of time to become the #1 country in steel production and steel consumption. Of the 1.5 billion metric tons of steel produced last year, China produced 45% of that, and of that amount, they consumed 46% of that. So they are a very, very big player. Why have they been able to do this? Apart from many other factors, the biggest one that we focus on is the support that the Chinese steel producers have been able to garner from their government, whether be it in the form of the all-important currency weakness that they enjoy. They have a relatively undervalued currency and have had for a long time. They also get support in the form of export subsidies, access to discounted lending rates, income tax reductions, VAT. I could go on, but all of these typically are focused on companies that meet certain export performance conditions. So then what do you do when you compete with a country like that? The first thing that we have actually found is that as a company, ArcelorMittal has been very effective at competing with Chinese producers at the primary steel level. So what we haven't seen are massive amounts of steel coming into South Africa, which are at the level of a coil, coated, galvanized, or whatever we produce. Where it's hurt us is coming in at the finished product level, at a very simple, low technology product like a stainless steel sink, for example, which apparently we can't produce anymore because all of them are coming from China. In the first 11 months of 2011, Chinese primary steel imports in South Africa only constituted 17%, which was down from 27% a year ago. So this is the kind of thing I'm talking about in terms of primary steel. We use anti-dumping, same as the US. US steel industry has been very, very active in anti-dumping, probably more active than anybody else. We do the same. However, the energy with which such things get done varies from one country to the other, and in ours, it's not particularly a big part of what we do. What helps South Africa is the fact that there is distance to contend with. For a Chinese steel producer to bring a product to Johannesburg, they have to face an additional $80 for every ton of steel just to get it from port to South Africa and into the inland. So there is some protection on that. But in my mind, the biggest protection we've got is the fact that we can offer our customers a service that the Chinese producer can't do. We have shorter lead times, which means our customers don't have to carry such large stocks. That's the first one. The second one is we can visit customers and see how they experience problems in using our products and begin to change some of the product specifications in order to address that. And that tends to be quite important, particularly the higher up the value chain one goes. Now, I have to, though, say that that is only applicable to maybe 50% of the steels we produce, because the other 50% are bottom commodity steels where delivery in terms of price and quickness of delivery are the only issues that are at play. We also do work with a university, a metallurgy department in one of the universities, in order to implement incremental advancements to steel that we produce for South African customers to address very specific South African requirements. So there are small things that companies can do to begin to address the issue of Chinese competition at a certain level. But at a finished product level, I have to be quite candid and say that we have not found the formula for addressing and encountering that particular threat. We have many companies today, particularly small and medium-sized manufacturing companies in the downstream sector of steel in South Africa that have basically stopped their lines, will import a finished product from China, which will land in South Africa, at or below their cost of production, and there isn't really a solution for this at the present time. Clearly, as China begins to slow, their growth begins to slow, here we now start to worry about chronic overcapacity in the steel sector, which means that the world may very well face a very, very different set of circumstances in 2012 and 2013 as we contend with that. Fundamentally, what happens in South Africa is that there is a mismatch between where we compete, which is at the lower end of the value addition spectrum, and the institutional arrangements that our government is beginning to put in place. The South African government has really moved the country to start resembling far more a developed country in terms of its environmental laws, its health and safety laws, which is good for staff and it's good for all of us who work in that industry. But the companies with which we compete from low-cost production markets like China may not necessarily have the same and may not have to incur the same cost. And it is that being caught in the middle because we don't produce the high-value-add product that a US or a European steel producer will do, and the low end of the market. And how this will pan out in the future is going to be very interesting to watch and to plan and to try and counter as we move forward. To conclude then, what I'm hoping by now is clear to you is that there are unique challenges of doing business in Africa, which I'm sure you're all very well aware of, but that companies working in Africa today find ways and means to be resourceful, to be adaptive, and to be flexible enough to contend with these problems. And that by and large, we do find solutions to them, and we do maintain a certain level of competitiveness. If again I use the example of Mittal South Africa, the way we benchmark ourselves is our cost position on the global cost curve. And up until very recently, we've been in the lowest quartile among steel producers in the world. So back to the Chinese competition issue again, that means we are more efficient at steel making than most Chinese producers, and that begins to be a source of real sustainable advantage. Naturally, this has a limit, so you can be resourceful up to a point, and the breakages come with infrastructure deficiencies. That has to be solved for African companies to continue to power economic growth and be competing on a par with their global peers. Finally, none of our dreams and hopes for the continent will come to fruition unless we solve the real thorny issue of skills and education. We have more than half of the African population of today being of working age, or in fact being under the age of 25. That means that skills development is a very, very, very big part of what we have to deliver in order for us not to produce a generation without hope. At ArcelorMittal, we have operated within the growing African market for a long time. We're one of those people that Catherine spoke about who have had in Africa bull somewhere in their sight for decades. As the largest steel producer on the African continent, our aim is to grow our footprint in key markets within the region and be part of the development that has to come to the African continent sooner rather than later. We wish to move from basic commodity to providing steel solutions to our customers over time, but we understand that maintaining and guarding a low-cost position as the key to competing effectively is absolutely key in those markets, because even in those markets we encounter competition. Today we have an established presence in East Africa and the islands, and we're extending our footprint into West Africa. Currently, Africa consumes 18 million tons of steel per annum, which is a tiny, tiny bit if you remember the total steel that is produced in the world of 1.5 billion metric tons that I mentioned a little bit earlier. But Africa also has 6 or 7 countries that are amongst the fastest growing countries on planet Earth in this decade. It's natural for most people to immediately think of mineral resources when they contemplate African growth, and as you can see, I haven't spoken about commodities at all, because Africans understand that diversification beyond commodities is absolutely key to create a sustainable platform for future success. Thus, we think the future will be dominated by 1, diversification, 2, an export orientation on the other side, and that export orientation includes intra-African trade, but in order for us to land that, we need to fix the issue of infrastructure. Regional blocs already exist, some work better than others, but on the whole, they're not delivering what the continent needs today, and this needs to be merged into ever larger consumer markets and more integration. But for all of this to happen, African companies, such as ourselves, must meet the challenge of being globally competitive. That concludes the formal part of the proceeding. I will now open the floor for questions. And Ania said we can take a few minutes to answer questions that you have from the floor on anything I've said or anything I haven't said.
Thank you. So we're only going to be able to take a very short question and keep it as a question.
I would like you to discuss a little bit the political environment effect on the business environment. How do the governments impact the success of business development in Africa? Because we know that Africa, we are facing poor leadership in government. There is the absence of visionary leaders, absence of leaders who are ethical, absence of leaders who can execute. And these create different impediments for the development of African business. So can you talk about this for us to at least know what's going on?
Again, this was a topic I didn't put on the table simply because if we get into that, we probably would never get to anything else. This is absolutely true. But I'm a great believer in dealing with things the way you find them. You deal with reality the way that you find it. And the reality that we have is that we have the leaders that we have. And no amount of imagining otherwise, hoping otherwise, or being optimistic is going to change this. You have to find, or we have to find ways to operate within those parameters and within those constraints. Where, for example, it hurts us the most are in areas like labor market flexibility. If you think about it, there is a thought process that the Chinese labor rates are beginning to move upwards and that very soon China may lose the status of having the lowest or cheapest labor in the world. And the question is, where's that going to go? Were we to become a little bit more creative, we could attract some of that low-cost manufacturing into some parts of the African continent. But we won't, because governments don't want to do this, and they want to pitch at a certain level where trade unions become very, very visible. So that's just what it is. We are going to miss this next wave of low-cost manufacturing unless government has another thought. Is government going to have another thought? I doubt it very much. So I think the main thing is that Africans, particularly business people, just need to find those wedges where they can open up the space just a little bit in order to be able to conduct their business and just stop worrying about the politics, because we have not been able to fix them, at least as business. Where you fix the politics is socially, through other social groupings, of which I am certain that all of us become involved from time to time. But in terms of impediments to business, they are serious, they are there. We have to find solutions as things stand today.
Thank you very much.
There was actually a question here that you just went straight past him. Where was it?
Yeah. So,
Yeah.
So, yeah. I think we would have opportunities to interact with Unku. We're sort of running behind schedule for the panel session.
Thank you.
Thank you very much, Unku.